Welcome to the Capital News. I am your host, Alex Karitis. Today is Sunday, June 13th, 2021. Thank you so much for joining me. I hope you're all enjoying your weekend. Title of today's podcast, Jobs. A long way to go. This is something I wanted to get to for about a week now. And my apologies for not being able to do as many as I have been in the past. But I wanted to talk about this because this is a fundamental and structural issue. And it's important from time to time to go back into the data and look at it from a long-term perspective so we actually know what we're looking at, right? We also want to know where we're likely headed in the future. That's really the important thing. And I think looking at some of this data a little bit more deeper provides that context to know how much further we really have to go before we are back to where we were prior to the pandemic. And even prior to the pandemic, we were operating on trillion-dollar deficits. Okay, you cannot forget this. So this has been a lot of funny money. This is a lot of economic smoke and mirrors for a very long time. And it can be argued that it has been an economic mirage and smoke and mirror show really since the great financial crisis. Okay, especially to this degree and with quantitative easing and everything else that has been implemented, well, we're really taking this to the nth degree. So they understand that the system is collapsing and they are doing their best to keep it pumping higher and higher. And to their credit, they have been able to pull this off because, at least at the moment, a lot of people, at least the majority of people, you get more buyers and sellers and things go up, right? They just don't care. They don't care about the fundamentals. They don't care about how disconnected equity prices are, bond prices are from economic reality. As long as their accounts keep going up, they don't care why. They don't care if it's because central banks are printing money. In fact, they love it. They can't wait for central banks to print even more, and that's exactly what they're going to do. Last week, we discussed how the ECB is going to increase the rate of their quantitative program. Bank of Canada is going to continue with low interest rates for as long as it takes. Yes, they're going to reduce their quantitative easing purchases, but they're still doing it. And then we'll hear from the Federal Reserve this week because they are going to conduct their FOMC meeting. So we'll have the Q&A session with Chair of the Federal Reserve, Jay Powell, should take place on Wednesday, and we'll cover that. But we'll hear their excuses. What's going on in the jobs market? What about all of these hotter than expected inflation prints that we have been seeing over the past couple of months? What are you going to do about it? How's the market responding to all of this? Because the knee-jerk reaction, and this has almost been how it's been every time we get one of these hotter than expected inflation prints, is that the dollar ends up rallying. And that's what happened across the board. The dollar has strengthened. One would think, well, if we're getting worse than expected inflation, shouldn't the dollar be sinking? And intuitively, you would say yes. But what's going on here is the markets still don't get it. They actually think that the Federal Reserve might actually start to increase interest rates or seriously taper their balance sheet, which is a complete nonsense. Because as we covered this just last week with the Federal Reserve, so they're going to taper their $14 billion. Meanwhile, over the past couple of weeks, since they've announced that, they have expanded their balance sheet by over $40 billion. So we're going to taper $14 billion. It's going to take us till the end of the year at least. But in the meantime, we're going to jack up our balance sheet to all-time highs. It makes absolutely no sense until you understand that the Federal Reserve is here for one reason and one reason only, and it's to jack up asset prices at any cost. They know what they're doing. They understand this. We know they understand this because Jay Powell was finally asked some tough questions, and he acknowledged some of it. With the quantitative easing program, with $40 billion per month in mortgage-backed security purchases, $40 billion a month. Yet we have all-time housing prices, and we have people starting to get out of the housing market. There's no more, people don't want to buy it because they can't afford it. You got higher prices and you got mortgage rates going up. It's a double whammy for these people. Can't afford it. Plus building costs. entire generation of would-be home buyers. This is what happens, all to keep everything looking okay. But once we look at these job numbers, you're going to realize that everything is not okay. So the dollar rallied across the board Thursday and Friday and just put a ding across those major currency pairs. Markets were a little choppy, but nonetheless closing up for the week because the equity markets are shrugging off all of these inflation figures as well. They couldn't care less because the only narrative that matters, as I continue to stress to this audience all the time, is the Fed's balance sheet and other central bank printing operations. It is causation. Look at the balance sheet, look at where the equity markets go, and there you have it. Remove all the funny money printing, and you don't have equities anywhere near these prices. You don't have real estate prices anywhere near these levels. You don't have commodity prices anywhere near these levels. But this is what they're doing. This is an inflationary environment, period. End of story. We got WTI closing at $70.78. Brent was at $72.65. Natural gas continues its upward trajectory at $3.28, putting on a gain of 4.25% on Friday alone. Gasoline pulling back a little bit to $2.18. Gold gave back 1.1% to trade at $1,877. Again, this is on the back of markets getting it wrong, in my estimation, in estimating that the Federal Reserve is going to taper sooner rather than later, increase interest rates, a combination thereof. I do not believe they're going to do this because we know what's likely going to happen in the equity markets. They will collapse because that's how fragile the system is. It cannot tolerate this type of increase to interest rates. Can't do it. We witnessed this in the fourth quarter of 2018, as we discuss here all the time. Silver also pulled back, but not as much, just down 0.25%, $27.89. Copper continued putting on a gain of 1%, $4.54 per pound. Lumber continued its sell-off, giving back almost 6% to trade at $1,059 per 1,000 linear board feet. So it continues to drop quite significantly. However, this is still above the levels where we were late last year, early this year. And recall, at those levels, those price levels, that was contributing to $24,000 in additional costs for a new home construction. $24,000. So that's sort of where we are at these levels. Last month, a month and a half ago, it was $36,000. That's how much lumber was contributing to the additional cost to build a new home. All right, so we're going to find out what's going on in the markets, how sticky these prices are, who bought what when, because all of that's going to have to be alleviated. You don't know if there were home builders who were trying to buy up lumber to get as much as possible, at what price, right? Because are they going to negotiate? Are they going to give up those margins? I mean, they'll get wrecked. And will home buyers, or do people who want to build homes, will they continue to stay in the market as well if they know they have to pay these outrageous prices just for lumber? Okay, so we really have a choppy road ahead of us, to say the least. And Uncle Sam's 10-year junk note is at 1.45%. So again, we are outside of the range where we have been for the past few months. And the bond market is basically shrugging off the inflation narrative as well, at least on a knee-jerk basis. Because treasuries, the bond market is not where you go if you're going to fend off inflation. Okay, but now you put the Federal Reserve in an interesting position. Because when yields were rising, they were saying this is a good thing. This is indicative of a growing economy. Well, now yields are falling. So does that mean the economy is weakening again? And if that's the case, well, what's the Fed to do? Are they going to start tapering? There's no way, because that's their narrative. Yields going up, growing economy. Conversely, common sense would tell us yields going down. Well, it must be weakening then. Well, if it's weakening, what does the Fed know how to do? Print more money, expand the balance sheet, come up with another emergency facility. So that's why I think gold and silver markets and the bond market, they got it all wrong. But of course, that's what makes markets fun and interesting. So we'll see who wins out at the end of the day. I think it's going to be commodities. I think it's going to be precious metals. But we'll see. So there you have it. So onward to some jobs data. And there's going to be a lot of it here. If you want to follow along, pause the podcast. You can do a Google search of Federal Reserve Economic Data. Federal Reserve Economic Data, FRED. And despite the fact that I rail against the Fed every day, they do have a good website for all of this data. I got to give credit where credit is due. So you can follow along in the search engine. Just type in labor force, and then a whole host of charts and graphs and topics will come up, and you can first look at labor force participation rate, which is where we are right now, and this currently stands at 61.6%. Okay, but what does that mean? All right, all of these numbers. And of course, this is in the jobs report. And this is one of those numbers we like to focus on because this is really under the hood, looking beneath just the surface and the headline figure that comes across the wires. So this really tells us if we're dealing with some sort of structural issue. Okay, so it's currently at 61.6%. Now this number peaked back in the late 90s. All right, over 67% back then. Okay, and as you can imagine, during the great financial crisis, this number got decimated, and it has pretty much continued its downward trajectory, really bottoming out in 2015. Okay, then it started to pick up. So sort of the latter half of the Obama administration and sort of somewhat continuing trend, picking up a little bit during the Trump administration. Now, I don't want you to get too bogged down when it comes to left or right with the politics. I want this audience to rise above this nonsense and to leave these parties because they don't care about us. But I'm just saying, as far as timing is concerned, who was in office when, okay? Because a lot of this is just simply a continuation of trend. And it doesn't make much of a difference who's in office because they're all screwing us over at the end of the day. Okay, so this number, labor force participation rate, has been on a downward trajectory ever since, let's just say, the dot-com era. All right, little bit of a pickup right before the pandemic, getting back to 63.4%. That's where we were. This thing plummeted, as one can anticipate and expect, because everything was shut down, and we went to 60.2%. Okay, now it doesn't seem like there's that much of a difference in these numbers, but that is a lot of people. And if you're looking at the chart, you can see how big of a drop-off this was. Now, despite the fact that the economy has quote-unquote been reopening for the past several months, this number still has a long way to go. We're currently at 61.7%, okay? And it actually, I'm sorry, 61.6% for the month of May. It was at 61.7 last month. So this number's actually gone down. And we have been plateauing and have been range-bound almost for a year now. All right, so it's going to be interesting to see how this number moves throughout the remainder of the year. We want this number to be higher. It means more people are working. Okay, labor force participation rate. That's what we want to see happen. But we also understand that there are a lot of distortionary effects at play with all of the unemployment benefits, with the PPP loans, with all of the money printing, all of the federal government programs. This still has a long way to go. There is going to be a lot of unraveling in all of this that we have yet to witness. Incentives have been changed. How many people are collecting unemployment benefits yet working under the table? Okay, there's a lot of questions to bring up, and we're going to continue making our way through a lot of these other metrics and breaking it down by age cohort too, because I think there's some interesting insights that we can come up with when we take a deeper look at it. So labor force participation rate has been plateauing for the past year, and that's not a good sign. It's not a good sign at all. We need this back up to where it was prior to the pandemic, and that's going to take a lot of doing, as we'll see here momentarily. So moving onward, again, if you're continuing to follow along, you can pause it, and what we're looking at now is all employees, total non-farm payrolls. So all employees, and this number is currently at 100, let's just round up, 145 million. Now, as one can expect, this number over the years continues to grind higher, at least when we're talking about the trend, and this is simply because the population has increased. Okay, so it makes sense. So there's nothing tricky about this. Now, of course, you'll have some major dips here or there depending on the recession, and again, the great financial crisis did some damage. Okay, but nonetheless, prior to the pandemic, we were at 152 million, all employees, total non-farm. All right, 152. We plummeted, again, as one can expect, during those lockdowns. Let me zoom in here. We dropped it down to 130 million. All right, so you're talking about 15 million people. All right, that's a huge number. All right, we know how heartbreaking it has been. And while this number has somewhat recovered, and it still is slightly continuing on an upward trajectory, is it at a strong enough pace that it's going to take us back to where we were, where we want to be? We want to be where we were prior to the pandemic, even though that was phony baloney too. Those are sort of the metrics the market is going to look at. Those are the metrics that the Fed is going to look at. These are the metrics that the Treasury Department and the White House are going to be looking at to say, have we made a recovery? Because that's sort of the baseline. All right, so that's why I'm mentioning this, regardless of the fact that I think that those numbers, even in 2019, were a bunch of hocus pocus, because they were. That's the baseline of which these idiots are going to benchmark themselves to say, okay, is there success? Are we back to those levels? Or can we continue to justify these nonsensical actions and continue to print money, continue to borrow and spend money like we're a banana republic? This is what you have to look at, all right? So again, all employees has recovered slightly and now is at 145 million, okay? But prior to the pandemic, again, was 152, 153 million. So still a long way to go. Basically, let's just say 8 million, all right? So we are in June. 6 months left to go. Some people project that we're going to get to where we were prior to the pandemic by the end of this year. Okay, well, if we're going to use this metric to get to those numbers, to get back to 152 million, we have to put on an additional 8 million jobs. That's going to be 1 million per month for the remainder of the year. More than 1 million. Now, we were told that the number was going to be 1 million back in April. We got 266,000. Now, one would think that the projections for the month of May would have been, well, okay, maybe it's just taking a little bit longer with the reopenings, etc., etc. No big deal. We were off a month, so instead of adding 1 million jobs in the month of April, let's project 1 million jobs. But those weren't the projections. There were some out there, but mostly it was about 650,000. And that's because all of these economists and market analysts got their butts hurt. You're projecting 1 million, maybe more, and you get 266,000. Something ain't right, Jack. So they pull back. They say expectations for May, 650,000. We get 559,000. They're not even close again. Yet more of the economy supposedly is reopening. So what's going on here? We have the ADP figures for the month of April that came in at 742,000. And we get 266,000. Big disconnect. Again, the ADP number came in at 978,000. We get 559,000. Huge disconnect. So what's going on here? And now we're supposed to believe, because Dingbat, our Treasury Secretary, Janet Yellen, says, oh, well, we're going to get back to unemployment levels pre-pandemic by the end of this year. Oh, really? Well, then I guess we're going to have to put on more than 1 million jobs per month for the remainder of this year. Could it happen? I guess it could. But that's really going to put a hurting on a lot of these economic policies, isn't it? How are they going to continue to justify printing more money? Because that's all the equity market needs in once. You've got more people working, especially if wages increase. Well, what are you going to do? You're going to pass on all of these price increases to consumers? Oh, well, I guess inflation's not going to be transitory, or you're going to get margins squeezed. That's not going to be good for equity prices, now is it? These people are trapped like rats. So those are the numbers that we were on to get to where we were pre-pandemic by the end of this year. I just don't think that's going to happen. over 1 million jobs per month for the remainder of this year. Don't think it's going to happen. Because we know so many businesses have been destroyed, especially small businesses, which is the driver of this economy. But the powers that be don't care about this. We know this. The PPP program was a disgrace. The Main Street lending facility at the Federal Reserve, complete disgrace, a complete slap in the face is all I'm concerned. They authorize $600 billion. They hand out like $10 billion. I mean, they're telling you right in your face. They don't care about these people. They don't care about you. They don't care about small business. It's all about consolidation. It's all about power. That's all it is. So that's all employees. Currently at 145 million, we still got a long way to go to get to pre-pandemic levels. On the employment population ratio, this number also peaked during the dot-com era, let's say, and that was about 65%, okay, give or take a little bit. And again, as everything else, as can be expected during the great financial crisis, this put a big hurting on it. Started to pick up again during the latter end of the Obama administration and continued its upward trajectory throughout the Trump administration, of course, barring the pandemic. So prior to the pandemic, the employment population ratio was at 61.1%. It plummeted through May, through April, and went down all the way to 51.3%. And again, if you're looking at this graph, it is a huge drop-off, employment population ratio. This too has recovered somewhat and is currently at 58% even. So we still got a few percentage points to go, and that still represents a ton of people. And this number has been slightly picking up month over month, which is a good thing. We'll continue to monitor this closely to see if this can pick up steam. But all of these numbers pretty much work in conjunction or in correlation. It's lockstep, okay? So we'll continue to monitor these closely, but just for perspective, 61.1% prior to the pandemic, 58% where we currently are now, a long way to go. All right. And now if we're going to look at some of these age cohorts. So this is the labor force participation rate for 25 to 54-year-olds. So this is the bulk of the workforce. These are your prime working years. All right. And this number peaked mid-late 90s. Okay. Starting to pick up again. Later stages of the Obama administration continued moving higher during the Trump administration, and we got all the way back up to 83%. All right, it peaked again late 90s, 84, 85%. So we still had a ways to go, but we were getting back there, and that's good. These are your prime working years. You want as many people in this age cohort to be working. All right, that would be the sign of a stronger economy. So we got up to 82.9% prior to the pandemic, and we dropped off all the way down to 79.8% for 25 to 54-year-olds labor force participation rate. Now, this number has not recovered as well as we would like to see, not even close. So, in June of 2020, and the reason I'm picking June of 2020 is because this is when this number sort of peaked, all right, from where the data has been trending since June of 2020. So we got all the way back up to 81.5% from that low of 79.8%. But ever since June of 2020, we have been lower. And over the past few months, we have flatlined at 81.3%. So that's not good. Now, is this a function of a lot of this age cohort, receiving stimulus checks, receiving extended unemployment benefits? And they're simply saying, I'm not concerned about it. I don't need to go back to work. This is perfectly fine with me. Maybe some of these people have started trading cryptocurrencies. Maybe they got a score here or there. Now, again, this isn't the majority of people. Maybe they started trading stocks and have gotten lucky a couple of times. Again, not the majority of people, but still, it's going to have an effect in the aggregate. Is it people at the upper end of this age cohort? Are they leaving the workforce? Are they retiring? Are they saying, well, my goodness, I got these stimulus checks, I got these unemployment benefits. And, if you're up in these older age cohorts, maybe you've put on a solid gain in the stock market. Maybe you've taken some profits. I don't have to go back to work. So how long-lived is this going to be? Because once we get to an older age cohort, we're going to see some of the effects of how recessions have impacted, particularly people at the upper echelon of these age brackets, and sort of getting them back into the workforce or keeping them out. Okay, because that's at play this time as well. All right, so this is a crucial number. The 25 to 54-year-old cohort labor force participation rate is currently at 81.3%. It is flatlining. So you want to get this number back up to where we were prior to the pandemic at 83%? Got a long way to go. This ain't going to happen overnight, especially when you've been flatlining for the past few months. Going to a younger age cohort, this is the labor force participation rate for 16 to 19-year-olds. And number peaked back in the late 70s at about 59% and has been coming down ever since, which of course is not a good thing because you want younger people in the labor force. You want them working. You want them getting experience. And so when you have these idiots, especially the Democrats, talking about implementing and enforcing a $15 per hour minimum wage, you are just going to decimate young people from getting work experience. It's not just about the pay. And that's all it's become in this country. It's all about the money. That's all it is. It's not about the experience. It's not about learning how to take some responsibility, how to take orders from a boss, how to work with a boss, how to work with colleagues, how to work with customers. And none of that. Not getting the hands-on experience, that counts for nothing. It's just a matter of how much you're actually earning. $10 an hour, $12 an hour, $15 an hour. It's all about the number. Doesn't matter about the experience that you're getting. That evidently doesn't count for anything. And that's going to continue to hurt these people. And they don't understand it. And they don't understand it because they don't have the experience. They just think, oh, well, I'm working, I'm getting up, I'm doing this, that, and the other. I'm entitled to at least $15 an hour. That's not how it works. And that's who this is hurting more than anybody, are the people who need it. But they don't get it. And of course, that's a failure of our education system as well. So this number has been just, it's a sad graph. If you're looking at this with me, labor force participation rate 16 to 19-year-olds. This has been on a steady decline. It has been plateauing ever since the Great Financial Crisis, following the Great Financial Crisis. But actually, and I don't know how long-lived this is actually going to be, but, everything else we've seen that big drop-off during the pandemic. But of the data points, this age cohort has actually fully recovered and has actually exceeded pre-pandemic levels. So that's an interesting take. Now, I don't know the numbers on the census side of things as to how big this age cohort is. Maybe over the past year and a half, it has shrunk, so maybe that's affecting the numbers. I don't know. Or maybe younger people are just getting back into the workforce, and those are the people who are taking some of these jobs, at least initially, with all of these help wanted signs up all over the place. Maybe it's the younger people who are jumping on board and saying, you know what, I do want to go to school. College is still expensive. This will help pay some bills. There's a lot of jobs available this time around. Let me get in there. Hopefully that's the case. And we'll see if this continues, because a lot of the jobs that were lost were low skill in, hospitality, restaurants, airlines, that type of thing. So this gives the opportunity for a lot of young people to enter the workforce and to start earning some money and hopefully save it, build up a nice little savings so they can start paying for college or whatever else they want to do. So that number currently is at 36.8%. Prior to the pandemic, it was at 36.2%. So we'll continue to monitor this closely as well. But that is at least some good news for at least the 16 to 19-year-old age cohort. Now, on to 55 and older labor force participation rate. Now, this number has been plateauing ever since the Great Financial Crisis as well. And as one can expect, in an event such as the Great Financial Crisis, this age cohort had to come back into the workforce throughout the entirety of the Great Financial Crisis. So some of these people may have been retired, because this is 55 years and older. okay? When you had all of those bankruptcies, all of those liquidations, when you had real estate prices plummeting, when you had 401ks, retirement accounts, trading accounts plummeting across the board, people had to come out of retirement and get back into the workforce. That's how destructive the great financial crisis was. And that's how destructive these lockdowns and closures would have been had it not been for trillions of dollars in funny money printing. If it had not been for trillions of dollars of budget deficits, spending money we don't have, stealing it from the future. And people don't understand this. And even if they did, they probably wouldn't care because it's their account that's gone up. They don't care about their children, their grandchildren, their great-grandchildren, future generations. They'll tell you they do, but they don't. Get real. Because you'd never tolerate any of this if they truly did. So one would expect during the great financial crisis for older people to get back into the workforce because they had to do it. They had to do it. This is when we found out about all of those frauds that existed. And again, we have yet to deal with the fraud cycle in our current environment because of all of the funny money sloshing around, keeping all of these frauds propped up. The great crisis, that revealed Bernie Madoff and a handful of other Ponzi schemes. But of course, Bernie Madoff was the granddaddy of them all. So he got all the coverage. But there was a ton of fraud that was uncovered because of the great financial crisis. You know how many frauds we continue to prop up because of our current actions? This is the zombification of our economy. This is not a healthy thing. There's no easy solution. But what is supposed to happen is what took place during the great financial crisis, where you had a lot of bankruptcies and liquidations, etc., etc. That is the healthy process. It's painful. Nobody likes it. But we can't continue to do this money printing because if we can, then why do we ever stop? Why even have the discussion, oh, well, inflation's running hot. Who cares? Just print more money. It's just transitory. It's really not that big of a deal. If you buy financial asset prices, you can get ahead of the inflation. So what's the big deal? Just print. Make everybody a millionaire. If there's no negative side effects to any of these policies. But they won't ever ask that question, and they'll never answer it if it is asked. But it needs to be. So, where are we now? Labor force participation rate, 55 years and over. So, pre-pandemic, I'll give you the level here in a minute. We're at 40.3%. We plummeted down to 38.4% in May of 2020. We rebounded up to 39.4% in August of 2020 and have unfortunately fallen from here. 38.2% in March, 38.3% in April, and 38.4% in May. So ticking up a little bit since March, but we have actually gone down, okay? And this could very well be because we have an opposite effect. Great financial crisis, housing prices went down. 401ks, retirement accounts went down. Now we have housing prices going up. We have 401ks going up. We have retirement accounts going up. So they're saying, well, I don't have to go back to work. I got stimulus checks. I got unemployment benefits. The stock market's on a tear. Housing prices are up. I don't have to go back to work. So these people are actually leaving the workforce. This has been completely flipped upside down. And we are still in the middle of it. How anybody can think that we're going to get back to normal is beyond me, because normal wasn't normal. Normal was not sustainable. We were weakening throughout 2019. That was on full display here at the Kapital News. I explained it day in and day out to you. Because I don't care about who's in the White House. A lot of you do. You think it makes a difference. It doesn't. It doesn't. Not when it's these people. Not when you're running trillion-dollar deficits. Not when you're not attacking the structural issues at play here. You don't fix a damn thing. You might move money around, because that's what happens. Democrats have their issues that they like, their industries that they prefer, and they'll funnel the money there. And people within mainly those states or localities or industries, they'll say, oh, look how good it is because I got all this money. Well, that's because the Democrats had it funneled there. And conversely, the Republicans have their issues in their industries that they prefer. And if they're in control, and they were, they'll funnel the money to those states and to those industries. And people will say, oh, look how great it is. Look how good Trump and the Republicans are. Well, that's just because you're getting the funny money. You're the beneficiary of the inflation. And you think that's a good thing. And it's not. That's the problem. That's why it's just a pressure valve. Just release it. That's all it is. Just relieve it. Oh, we got a Republican in there for too long. Now we got to put a Democrat in. Oh, we've had the Democrats in for too long. Now we got to put a Republican in. And it just keeps everybody calm. Divide and conquer. That's what they want. That's the game they're playing. And look at the game that they're playing. Look how it has distorted all of these markets. Look how it has distorted all of these economic variables. And we have yet to deal with it. We have yet to deal with the full fallout of all of these things. Once the unemployment benefits stop, once the forbearance and moratoriums stop, what's going to happen? Once markets realize, again, in my analysis, my opinion, that inflation is not transitory, then what's going to happen? What about the fraud cycle that we have yet to contend with because this is the zombification of our economy? You think you're out of the woods. We're just getting started. Jobs, a long way to go. I hope that was informative. If not, you can at least know where to go to look at this data on your own time. Stay diversified, stay vigilant, and stay with the Kapital News. I am Alex Karitis. Godspeed.